Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is June 18th, 2025. We have an interesting market. We have an interesting world. Things are kind of crazy, but the market's going up and down trying to react to it. The thing I think that's the most prominent right now is geopolitical risk in the Middle East, but there's also tariff impact and demonstrations and protests and so forth in the U.S. A lot of this some of it is causing reaction in the markets, and frankly, some of it isn't. So, but I think the biggest issue right now is the Middle East. Okay, so let's jump into this. This will be from this past week. You can see from the green dots and red dots on the right side indicating that these major indexes are above their moving average or below, green meaning above. And in the yellow box in the center is the what happened last week. And in virtually all cases, there is a slight decrease or a slight increase. Most of them are decreases, except the Dow was down 1.3 and the government bonds were up 1.15. And then the Russell 2000 small cap index, ETF, IWM, was down 1.42. Year to date, really you have two huge winners, both of them foreign markets, developed markets, EFA, and emerging markets, EEM, both up 18 and 12%. U.S. markets are either slightly up or negative. The S&P 500 breaks down into its 11 sectors, industry sectors, major sectors, and the yellow box again indicates last week, the red box indicates year to date. Now, they are ranked based on the year to date number, not on the weekly number. You can see the biggest loser, two of them really, this past week were retail and financials. The biggest winners were healthcare and energy by far. So in a defensive environment or in a negative environment, the market will, the S&P, those sectors that are more defensive, like in this case, healthcare or energy, are going to perform better. And that's exactly what happened. Those that are more aggressive would not be. So when you look over on the right side, the red dots, green dots above the 20, 50, 100, and 200-day moving averages, you can see that there were 30 green dots compared to 35 last week out of 44. The S&P 500, the market last week, using the S&P as the example, was slightly down, almost break even. So you can see that, maybe you can see that at the very end, there's a little bit of a tick down, not much. So still, based on my black arrow, still in a major upward trend and above its 20-period moving average. When I put that on a candlestick chart, you can see a little more detail on it. The hollow candlesticks indicate it's going where it starts and where it ends is going up, and the red starts and then comes down. So it has moved from April 7th this year, so a little over a couple of months ago. It has moved up nicely. You can see that at the far right, where it went down a lot, and that was during that first quarter where we were, their tariff issue. Tariffs were being announced almost daily. We're going to put a tariff on this country or this country. Then there were counter tariffs or negotiated tariffs and so forth. It was kind of wild. And that's what caused, in my opinion, what caused the market to go down. But that they seemed to settle out. And even though there's a war risk going on right now, the market is still, generally speaking, moving up from its bottom of April 7th. I squeezed that down to a daily chart since for just the last 3 months. So in the last 3 months, looking at it daily, not weekly, you can again see more detail here. Most of this is up, but again, it's moved up and now a little bit sideways, but the market is not pulling back at this point, even though there is a lot of risk out there. So this is a relative strength chart of the NASDAQ 100 QQQ compared to the S&P 500, which is the broad market, and over a 30-month period. So this went up a lot in 2023, and then from beginning of 2024 to present, so this would take us about almost a year and a half. You can see as it goes, it kind of goes up and down, but it goes across the chart. So, but right now it's above its 20-period moving average and seems to be in a kind of a sideways pattern. The S&P 500 has got two major kinds of stocks: growth stocks and value stocks. Those are put into baskets called SPY-G for growth and SPY-V for value. And though I compare those ETFs on a relative strength basis, showing SPY-G growth as the numerator, SPY-V value as the denominator. So again, this has gone up and down a lot, but from this period of, I'll say, late March to present, it has heavily favored growth. The S&P 500, I'm comparing it on relative strength to the IWM, the small cap Russell 2000 index, and it SPY, S&P 500, is the numerator, IWM Russell 2000 is the denominator. During all of this year, and probably since late November of last year, the S&P 500 has outperformed the small cap index, IWM. And you can see that, on the right part of the chart. Long-term government bonds have been under pressure since really about the last 5 years. It's a 5-year chart, so you can see where that's gone, up and down, but mostly down. This is a part of traditional portfolios, and they're under a lot of pressure because you can see the equities have gone up, but the bonds have been pulling them down. So this is just the long-term government bond. There's the intermediate term, short-term government bonds, corporate bonds, municipal bonds, and even junk bonds. But a lot of investment managers, portfolio managers use government bonds, either intermediate term or long term, as a way to counterbalance equity risk. This has not done a good job of doing that. Then I take the same ETF, TLT, long-term government bond, and I put a chart since August of 2024. And this, you can see the general direction, the short term and the longer term, is moving down. The dollar continues to weaken. You can see it's gone up and up, but since the beginning of this year, it has been moving in a downward direction, including this past week. So weakening dollar, meaning that when we spend money overseas, we're buying goods and services in other countries or currencies, our dollar does not go as far. When they spend their dollar or their currency in our economy, the dollar goes further if we have a weakening currency. Gold is still rocketing up. You can see this is from late 2022 to present. A lot of that time, almost all of it, is above the 20-period moving average and still moving up. Silver is more volatile, same thing, it's moving up and moving up more dramatically. And even this week, the week of the 16th, it's again outperforming gold. So silver is kind of on a tear right now. Bitcoin has leveled off, and but it's above its 20-period moving average, and over this 2.5-year period of time has done well. Volatility, the volatility index, the VIX, V-I-X, I put a red arrow to show you where it is today. I also put a black line arbitrarily to say this is where I consider risk. When it rises up through that black line, that's when risk in the market, the equity market, the S&P, that's when that risk starts to increase to a higher level. It's not there yet. And this is as of Friday. The U.S. market, represented by SPY, S&P 500, compared to EWY for South Korea. I picked South Korea because it's an easy chart to work with, the relative strength between the two. It's either going up or it's going down. But if it's going up kind of smoothly. And if it's going down kind of smoothly compared to some other countries. So again, this shows by going down, it's putting EWY, South Korea, in a much more favorable position. I suspect if I compare this to 10 or 20 other countries, you'd see the same thing. They would be more favorable than the U.S. So this is the U.S. market, not the U.S. currency or the U.S. economy. Okay, gold and silver, as of last Friday, gold is up to $3,433 an ounce for spot, and that's a 3.7% increase over the previous week. And silver is up to $36.31, up 0.9% over the previous week. Gold-silver ratio is 93-1. And what we're seeing now with silver going up more than gold, we're seeing that what I've said is this favors silver as a better value. And so what's happening is people are there are still people buying gold, but the move into silver is higher because this ratio tells you that it's probably a better value. A monster box of silver, 500 ounces, is now over $19,000. If you watch this for a while, you know it wasn't long ago when it was $12,000. That's a pretty big increase. That includes, it's 500 rounds at spot plus $1.94 for a markup, retail markup, bringing it to $38.25 per round. And the source of that is my son Preston, who is a precious metal dealer. Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.